Welcome back, Mortgage Sensei here. Today we're going to talk about FHA. FHA loans. Okay, let's dive right into it. So first thing, what is an FHA loan? FHA loan is a loan that is insured by the government. Insured by the government. Okay. Now, what insured by the government means exactly is that when you do a loan, a FHA loan, right, and the lender, the bank, is originating this loan for you, putting the loan together for you so you can close, right? What it means is that if you default, right, if you don't make your payments, if you go into default and you go into foreclosure, right, then the insurance portion of the payment, because you're paying private mortgage insurance or mortgage insurance premium is really what it's called. The insurance that you're paying on the loan, when you default, the lender can go to the government and the government will pay out the mortgage insurance or pay out the policy to the lender so that the lender can liquidate and then, offload the property, foreclosing, go through the process of foreclosing the home. But they receive money from the government to go through that process of foreclosing on the home and then eventually sell the home and re-lend out to someone else. Okay. Now, next question, why? Okay, Nelson, why would I want to go with an FHA loan? Because it qualifies you. Qualifies you. Okay. Now, what I mean by that is, let's say you can't qualify for a conventional loan, right? Nelson, I want to go a conventional loan, but my credit score isn't high enough, right? Nelson, I want to go with a conventional loan, but they're not giving me as much as a loan that I want, right? Or that I need for me and my family, right? You should look at an FHA loan. FHA loan allows you to get qualified with lower credit scores than conventional loans and help you qualify on standard higher debt to income ratios than conventional loans, right? It's insured by the government. So the banks, the lenders, we like FHA loans, but we prefer conventional loans, okay? Now, from there, let's go right into it. How? Okay, Nelson, how do I qualify for an FHA loan? So we're going to break it all the way down. It's always the same four: credit, DTI, funds, and property type. It's always the same four. So let's go right into it. Credit. Okay. Now, when you're looking at FHA loans, right, it depends on the lender, right? It depends on the lender because not all lenders play in this arena, right? They have what is called lender overlays. We'll do another video on that. But lender overlays, real short, basically means that, the FHA said they'll do it, but the lender said we ain't doing that FHA. I know you'll do it, you insure it, but that's too risky for us, the lender. That's a lender overlay. Now on standard, minimum credit score is 580, right? So 580 or higher, right? 580 or higher, okay? Now, you can also go lower than a 580, and you can go down to, some lenders will go down to a 500, to 579. Now, I'm putting those separated out. And I'm separating out for the most part because it depends on what the lender is willing to do. Not all lenders are the same, okay? Like for instance, banks and credit unions, they like to stay on the higher end of credit scores, right? Credit unions, they may give you a great deal, right? But they're gonna make that box small for people to fit into. Next, after that, let's talk about debt to income ratio, DTI, right? Debt to income ratio. Now here, when you get to debt to income ratio, your credit score really start to play a factor here as to how high of a debt to income ratio FHA is willing to go for your loan. Now, in my experience, right, again, each lender is a little bit different, but as a mortgage broker, I work with well over 40 different lenders. So in my world, all I got to do is just find the right lender for you. Now, when we talk about debt to income ratio, if your credit score on average, and guidelines tend to change and with the market, right, and with what the government and legislation changes to, but let's say your credit score is a 640. There's that magic number again that I always talk about. Your credit score is a 640. Well, in most cases, right, depending on the lender, you can go up as high as 65% total debt to income ratio. That gives you a lot of room to buy a house. A lot of room to buy a house. Now, let's say, okay, you're not at a 640, right? But you're somewhere between a 639 and a 620, right? You're somewhere around there, right? In that range, they may go up to 50, maybe 55%. They may, right? So you lose normally about 10, 15% on your debt to income ratio when you fall in here. Now, again, it depends on the lender, but we're just going with a very broad understanding. That way you can start working in a way. And if a lender says, no, we can't do it, then you kind of know, you start to pinpoint where you're at. Because not all lenders are going to tell you, oh, you don't qualify because your credit, and this is what you need to do and how you need to go about fixing your credit so that you can qualify at a later date. Or you don't qualify because of your debt to income ratio, right? So here's what you can do, and this is how you go about doing what you need to do in order to qualify for a loan. Most banks and lenders are not going to do that. And this is what that channel is all about. Now, let's say you're under that, right? You're between a 580 and a 619, right? If you're between a 580 and 619, normally you're going to be capped somewhere between 45% and 50%, right? You're going to be capped with your debt to income ratio, total debt to income ratio, okay? Now, let's say you are under. So you are less than or equal to a 579. You're less than or equal to a 579. Now, in most of those cases, you're going to be capped right around 43 to, well, let's just say 43%. It's more normally what you're going to be looking at. You're going to be capped at 43%. It may be less, but you're going to be capped around there. Now, again, the goal is to try to look as bankable as possible. Remember, when a bank is looking at your loan, and let's go ahead and put the last section here, or next to last, funds. When a bank is looking at your loan, they would like to see high credit, low debt to income ratio, a lot of funds, right? That's normally what a bank wants to look like. But what happens, and where people tend to get very discouraged at, is that their credit is low, their debt to income ratio is high, and they have little to no money, and then they don't get qualified, and then they don't understand why they didn't get the loan. Or let's say they have a high DTI, but they have low credit, right? And no funds, and so on and so forth. It's a mix and match combination, right? But again, you always want to look bankable. So high credit, low DTI, and high funds. And I'm gonna do another section on credit, and we'll do a dummy one on debt to income ratio. So let's talk about funds, right? Now, again, we're talking about FHA loans. FHA loans. Now, if you're at a 580 or more credit score, right? Your minimum down payment is 3.5%. 3.5%, right? Up to the FHA county limit. So each county has a limit on how big your FHA loan can be, right? So get with a mortgage professional like myself to make sure that in your area, in your county, you know what your max county limit is and you stay within it if you're planning on going with FHA. Same thing with conventional. Conventional has a max limit too. Now, let's say you are, again, you are less than or equal to 579 credit score. At that point, it jumps from 3.5% to 10% down payment. Now, what I normally try to do here, or for all of my clients, I recommend you get to a 640. I'm telling you, 640 is the number. Doors fling open, opportunities fling open, lenders and banks start giving you all kinds of money to do business with you the moment your credit score gets over a 640. Right now, your debt to income ratio is you managing your money correctly, right? How much money you're bringing in versus how much money is going out. And your funds available is a reflection of your debt to income ratio, meaning that the more cash you have coming in versus the money going out, and how well you save and put that money to a side. How well you save, you invest it, make it readily available. Now, last but not least, let's talk about property type. Property type. Okay, because again, it's always these basic four. So when you talk about property type, you can buy with an FHA loan. You can buy a single family residence. You can buy a condo. You can buy a townhouse. You can buy a manufactured home, modular home, right? Just like conventional loans, you can buy up to a 4-unit property. That means you live in one unit. You got 3 other units, right? That you want to rent out to somebody else. You can do all of that, right? And you can use that all with an FHA loan, okay? Now, again, the main purpose of FHA loan is so that you can qualify for a loan and or for the amount that you want, because you can't go with a conventional loan, or because you don't want to go with a conventional loan because the cost is so much more, right? That's the purpose of FHA loans. That covers it for this section when it comes to FHA loans. If you would, please drop a comment, subscribe, check out the description below. I got a lot of jam-packed information in there. Submit an inquiry if you want to go ahead and start the process with me. As of this timing of this video here, please check the date. I am licensed in the state of Georgia, Tennessee, and Florida. I will be expanding out into more states in order to help more people as we grow. But my growth is a direct reflection of how much value you receive from this channel. So please, drop some questions. Let me know what you want to talk about, what you want to know. It can be as basic or as mastery level as you want. I've been doing this for 10 years. It's nothing you can really catch me off guard with. And I'll create a video, and I'll look forward to helping each and every one of you to make it to the other side of home ownership. Mortgage Sensei out.